This is the first in a series of videos where we're going to analyze the accounting for notes receivable. Again, you can see attached to this video the case. It is Whatcom Appliance and Furniture Store. You may want to pause at this point and print that. In this video, we're going to be focusing on number 1A. Basically, on September 1st, the Whatcom Appliance and Furniture Store sold some furniture to a law firm. The sale was for $30,000. So let's put this up. The sale was for $30,000. They had originally purchased this stuff. It was in their inventory for $20,000. The law firm put no money down but agreed to pay all of it in interest at 8%. They're going to, in 6 months. So the interest rate is 8%. And they're going to pay it in 6 months. So basically what has happened was Whatcom Appliance and Furniture Store has financed this transaction. So in this video, we want to apply A, and that's record all the journal entries necessary for the sale of the office furniture if WAFIS or Whatcom Appliance and Furniture Store holds a note to maturity. All right, so let's start out with the, if this transaction here took place on September 1st. So on the date of sale, we're going to have two things happen. We're going to have a note receivable, which kind of substitutes for traditionally what we have done as accounts receivable. And we're going to record the sale. And again, I'm a stickler about breaking these things up and to keep the journal entry as simple as possible and no simpler. And we're going to record cost of goods sold for $20,000 and inventory of $20,000. All right, so that's the journal entry on September 1st. Because this is a 6-month note, we're going to have to make a year-end adjustment. So at December 31st, we're going to have to make another journal entry. And that journal entry is basically going to be accruing, well, let me count this, September, October, November, December, 4 months of interest. Okay, so at December 1st, let me do a little bit of calculation here. This is a $30,000 note. It's at 8% interest, and 30,000 times 8 is 2,400. I am then going to multiply it by the entire period, so 6/12. So if it's outstanding for an entire 6 months, we will receive $1,200. Okay, but we're only holding it 4 months, so I'm going to divide this by 6 and get $200 a month, and then multiply it by 4 months, and I believe, if my math is right, that's $800. So at December 31st, my journal entry would be interest receivable, because now I am owed 4 months of interest, and I would credit interest revenue for $800 also. Okay, so that's my journal entry at December 31st. Now, we only have one journal entry left, so we're also going to hold this thing for all of January and all of February. So on March 31st, well, on March 1st, we're going to get paid. The law firm is going to completely pay us for the note, so we're going to receive cash. And how much cash we're going to receive? Well, we're going to receive the $30,000 of the note plus the $1,200 of interest they're going to owe us on this note. So the cash we're going to receive in total is $31,200. So cash of $31,200. I know that the note receivable is going to go away, and that's $30,000. I know the interest receivable is going to go away. This interest receivable I accrued at year end, that is going to go away because now we're getting paid. It's no longer receivable. It's been received. And the last piece then would be interest revenue. And how much will that be? Well, it's $200 a month. There was February and January. That's that's not 11. I was doing tallies there. So that should be another $400 in interest I should recognize. And does that, yes, that all equals. So there's the journal entry I would make on March 1st when I actually got paid. So this is all the journal entries and accounting for an interest-bearing note that spans year end.